Okay. Now, I want to talk a little bit about just sort of the demand for this kind of security. If you look at the case, you'll notice that they talk a little bit about sort of some history here. So, one of the things that we see here is that, investors in general probably, this is Corning is giving you kind of a good example of what growth looked like. A lot of these companies in the telecom era did really well for a while and then they flamed out. You could also say the same thing for .coms and other high flyers. If you want to see sort of more of a mutual fund sort of view, you can look at this next page here in the case where they have sort of this big up and down, and this would be for the kind of income or mutual funds. Now, the equity mutual fund flows and returns are sort of over in this area. And I should say more along the lines of the fund flows, for example. So one of the things so this is returns, this is flows. But one thing that you kind of see here is you could see the big interest in growth for up until about late 2000 or in through 2000. But then you saw a big decline. Income-oriented funds were not very popular. But then what happens is you start to see the income-oriented funds sort of start to take off a little bit. And in this case, if I go back to the questions, we would be looking at, maybe I just sort of take a break here. So some of those early slides were talking about how the business performs, what happened to the valuation in Corning stock. So we've kind of talked a little bit about that. Why do they need to raise capital? How have they raised in the past? There's an exhibit that kind of talks about it. It's mostly they've sort of raised debt and equity to do acquisitions. Again, we talked a little bit about why it'd be hard to raise equity now and debt now. So there should be some discussion around some of that stuff. Again, as long as they're hitting some of the points that I talked about, that's fine. We'll talk about this in a second. One of the things that this is kind of getting at, though, is like, why would J.P. Morgan have this particular security? What factors will determine whether the proceeds, Corning proceeds the offering, etc. But one of the things one of the big reasons why is that growth is a little out of favor. And so this security at least would give investors the ability to make some income. And it'd be nice, I guess, depending on what you get back from students, it would be nice if they were touching on this. Because, at some point, they have to sell the security to somebody. It might be hard to sell straight equity, but if you could sell something with an income function or income characteristic, it looks like that's been more favorable lately, and also, by the way, hasn't dropped off. The performance of these growth and income funds haven't dropped off as much either. So that might be a big reason why J.P. Morgan is designing the security this way, to sort of get at a clientele. Recently, convertible income and convertible arbitrage funds had outperformed equity and growth funds as well. So that's so something about the client demand might be kind of interesting to see. Again, if nobody has it, then I wouldn't make a big deal about it. But if you're seeing some groups had it and some didn't, maybe that's worth a half-point differentiation. All right. I would think that students would do reasonably well on this valuation of the security. We went through some of this in class beforehand. Recognize this is right before spring break, so I knew that I knew there wouldn't be necessarily maybe the top effort that we would see throughout the semester. So I kind of talked a little bit about the present value of the dividends. All they do here is just sort of take the $7 dividend on the preferred stock, break it up into quarters. It's $1.75 per quarter. Take the present value of that. It's about $20. Then I add the value of the options. So they end up with a mandatory convertible that has a 3-year life, and then the exercise price is $3.15 on the ones they sell, the calls they sell, and $3.84 on the calls that they go long on. You take the PV of X, you get S is $3.15. Now, one difference that I will have from students is they very well may have used the 60% as the volatility, and that's fine. I said that's acceptable to do that, but some of them may actually have went and done the implied volatility based on some of their other securities. So you'll notice that, let's see here, do I have it? I apologize, I've got a number of things up right now. I think I'll attach this spreadsheet. You could go and use the implied volatilities of, they had some other securities that were trading in the market. I think it's on Exhibit 11. And they were similar in maturity to this, so you could get implied volatility that way. I think I ended up using like 80% based on that. But again, let's not get too worried about whether students use this or not. But what you would do is you'd use the price, the bid prices on the calls, and then say what volatility is implied based on those bid prices to come up with the volatility that you would use here, and it comes out to about 80%. So that's another approach that I just demonstrated. Again, if they use 60, it's fine. It's going to change these numbers slightly. They'll both go down slightly, but one's kind of canceling out the other because this is a short position, this is a long position. And these are the number that they would have to go short. So we did a diagram together and set this all up. So those numbers should be pretty good. So now if I have the short call, the value I put on it was 165 times that got negative 52.44. Again, if they use 60, it should be slightly lower. And they have a long position in the stock for $100, and then the long call would be 150 times 26 to give us 39. So we'd have a value of about 86.57. They have 20.41 is the present value of the dividend, so the security value is about 107. So in this case, if we go back to the questions here, you know, the theoretical value of the mandatory preferred convertible in Exhibit 10 would be about 107. They may have, I think if they use 60%, it'll be 108, so that's fine. So that would be the valuation. Walk through those slides. Then, is the proposed structure and pricing a fair deal for investors? It's a very good deal for investors. If they invest, they're going to get, you know, 107 worth of value, or 108 if you used alternative approach, but somewhere in that range, and they're only giving up $100. So in my opinion, this would be a good deal for investors. The biggest problem is that they would have to hedge against the fall in stock price, which a lot of them would probably do, but that would allow them to lock that in. Some of them will actually in the way it worked out, a lot of them opted for early exercise. They don't get quite as much money, but they locked in a profit in a couple days as opposed to having to wait 3 years for the profits. So does it address Corning's financial situation? Well, to the extent they need to bolster equity capital, it does. So in some ways, maybe that's the case. Now, there's a whole part you'll notice if you go beyond these notes in my notes, there's a whole discussion about the preferred, you know, there was this immediate conversion and it ended up going really haywire and things like that. So that's not really something I expected them to sort of be able to discuss in this case. It's a really interesting part of the case, but I didn't really go there with them because I think it would just be, it's almost good to set this up and say, okay, here's what we thought was going to happen, and then something very different happens. So beyond this slide, starting with this slide and beyond, don't worry about it. It's just stuff that I talked about. Again, I think this is a case that can be pretty useful and get them to think a little bit, but it's kind of hard to, you know, after the fact, just given that there's not a ton of differentiating things in this case. I try to set them up in this case pretty well so that they have a pretty good sense for what happened here, and then just do some basic calculations. I'm also trying to get them more comfortable with Black-Scholes calculations and seeing it as another application. So overall, again, I don't expect, you know, again, that low. I mean, I think the medians will be relatively high, and that's fine. Just make sure that they're writing it up well and that they have some good, you know, easy to follow logic and things like that. It should be fine. All right. Best of luck. Thanks.